The suits have arrived. BlackRock, JP Morgan, Goldman Sachs, Fidelity, BNY Mellon. These are not crypto bros. These are the most conservative, risk-averse, heavily regulated financial institutions on Earth, and they are buying crypto at scale. Not testing, not piloting, buying. 115 billion in Bitcoin ETFs, 60 billion in corporate treasuries, billions more in tokenized assets. This is not speculation. This is deployment. So let me show you why the smartest money in the world is entering crypto right now and what it means for prices, for adoption, for you. Reason 1, the inflation hedge thesis proved true. 2021 to 2024 was an inflation crisis. Central banks printed unprecedented amounts of money during COVID. The purchasing power of fiat currencies eroded visibly, and institutions watched their cash reserves lose value in real time. That created a problem. How do you preserve purchasing power when governments can print unlimited money? Gold was the traditional answer, but gold is heavy, slow to transfer, hard to divide, not digital. Bitcoin offered something no central bank can provide: mathematical scarcity. 21 million coins, forever, algorithmically enforced. No government can change it, no CEO can dilute it, no board can vote to print more. When the world printed trillions, Bitcoin stayed at 21 million, and institutions noticed. BlackRock called it a hedge against monetary debasement in their 2026 outlook. Not speculation, hedge. That word matters because hedges are what conservative institutions buy to protect portfolios, not to gamble. And the data proved them right. From March 2020 to December 2025, while M2 money supply exploded, Bitcoin went from 4,000 to over 126,000. That is 3,000% appreciation, while cash lost 20% purchasing power to inflation. Institutions holding Bitcoin preserved wealth. Institutions holding only cash lost wealth. The experiment is over. Bitcoin works as an inflation hedge. Now the smart money is positioning for the next cycle. Reason 2, spot Bitcoin ETFs changed everything. January 10, 2024, the SEC approved spot Bitcoin ETFs. That single decision unlocked trillions in institutional capital that could not touch crypto before. Why? Because pension funds, endowments, insurance companies, and banks have rules. They cannot buy unregulated assets. They cannot custody private keys. They cannot explain blockchain to boards of directors. But they can buy SEC-approved ETFs. Same compliance, same custody, same reporting, just packaged for institutional workflows. BlackRock's IBIT launched January 11, 2024. It became the fastest-growing ETF in history, 50 billion in assets in under 1 year. Fidelity's FBTC hit 30 billion. Combined spot Bitcoin ETFs, 115 billion in assets as of March 2026. That is institutional money, not retail. Pension funds, family offices, sovereign wealth funds, the conservative money that moves slow but moves big. And here's the key: ETFs are just the entry point. Once institutions get comfortable with Bitcoin exposure through ETFs, they start exploring direct holdings, corporate treasuries, tokenized assets, stablecoin settlements. The ETF is the gateway drug, and institutions are hooked. BlackRock CEO Larry Fink said Bitcoin is digital gold and called tokenization the next generation for markets. That is not hype. That is the world's largest asset manager with 10 trillion under management telling you where finance is going. Reason 3, regulatory clarity finally arrived. For years, institutions stayed away because regulation was uncertain. Is Bitcoin a security, a commodity? How do banks account for it? What are capital requirements? And custodians hold it? The ambiguity was a blocker. Nobody wants to deploy billions into legal gray areas. But 2025 changed everything. The Genius Act passed in July 2025, Federal Framework for Payment Stablecoins, clear rules, one-to-one backing, monthly audits, real-time redemption rights. Banks can now use stablecoins for settlement without legal ambiguity. The SEC withdrew Staff Accounting Bulletin 121 in January 2025. That rule forced banks to list customer crypto as both asset and liability on balance sheets. It required holding capital reserves against assets they did not own. That made crypto custody impossible for banks. SAB 122 eliminated that. Now, banks can custody crypto using conventional loss contingency frameworks. No crazy capital requirements. And the FASB released Accounting Standards Update 2023-08, Fair Value Measurement for Cryptocurrency Holdings. Before, crypto was classified as intangible asset, marked down on impairment, never marked up. That was insane. Now, fair value adjustments hit income statement each period, up or down. That's how normal assets are treated, and it makes crypto investable for institutions. And in March 2025, President Trump signed an executive order creating a strategic Bitcoin reserve. The United States government designated over 200,000 seized Bitcoin as a national strategic asset. When the United States treats Bitcoin as a reserve asset, every other institution has permission to do the same. That signal matters. Regulatory clarity is no longer a barrier, it's an accelerant. Reason 4. MicroStrategy proved the corporate treasury model works. MicroStrategy, now rebranded as Strategy, they were the first public company to convert cash reserves to Bitcoin, August 2020. Most people thought they were crazy, converting balance sheet to volatile crypto? Insanity. But CEO Michael Saylor had a thesis. Cash is trash. Inflation destroys it. Bitcoin is digital property, scarce, portable, durable. So he started buying, and he did not stop. As of March 19, 2026, Strategy holds 761,000 Bitcoin, valued at $56 billion. That's 2 to 3% of Bitcoin's total supply held by one company. And here's the crazy part. It worked. Their stock went from $100 in August 2020 to over $500 by late 2024. That's 5x, while Bitcoin went up. Their leverage to Bitcoin created massive shareholder returns, and Wall Street noticed. Now, dozens of other companies are copying the model. WindTree Therapeutics allocated $520 million for BNB holdings. Sharps Technology committed $400 million for Solana. Corporate Bitcoin treasury holdings surged past $6.7 billion across all companies. This is not one crazy CEO anymore. This is a movement, and it proves that corporations can use Bitcoin as treasury reserve without blowing up. The experiment worked. Now it's replicable. Reason 5. Tokenization is the next $10 trillion market. Institutions are not just buying Bitcoin, they're building infrastructure for tokenized finance, real-world assets, bonds, real estate, private credit, commodities, art, all being digitized and put on blockchain rails. Why? Because tokenization solves real problems: faster settlement, 24/7 trading, fractional ownership, programmable compliance, lower costs. These are not theoretical benefits. These are operational improvements. BlackRock launched BUIDL, a tokenized money market fund. It crossed $1 billion in assets by March 2025, and it became eligible as off-exchange collateral. That means institutions can use tokenized cash equivalents in margin accounts. That's huge because it proves tokenized assets can integrate with existing financial plumbing. This is not replacing banks, this is upgrading them. JP Morgan runs Onyx. They use JP Coin for same-day settlement. Goldman Sachs operates GSDApp, a regulated platform for clients to issue and settle digital instruments. These are not pilots, these are production systems processing billions. And private credit is leading because tokenization solves illiquidity. Private loans historically sit on balance sheets until maturity. No secondary market, no price discovery. Tokenization changes that. You can trade tokenized private credit, create liquidity, optimize capital. That's why institutions are pouring money into this space. Franklin Templeton runs a $270 million tokenized fund on Stellar, targeting $3 billion by end of year. When $500 billion asset managers build on your blockchain, that is not speculation. That is infrastructure. Reason 7. Sovereign nations are buying. First mover pressure. El Salvador made Bitcoin legal tender in September 2021. Most people laughed, a tiny country with no financial credibility. But they held, and they accumulated. Bhutan quietly mined Bitcoin using hydroelectric power, holds substantial reserves. And in March 2025, the United States created a strategic Bitcoin reserve, 200,000 Bitcoin designated as sovereign asset. When the United States does it, other nations pay attention. Fidelity published research predicting more countries will add Bitcoin to foreign exchange reserves in 2026. Chris Kuiper, VP of Research, said, quote, "If more countries adopt Bitcoin as part of reserves, pressure for other countries to also do it could increase as they may feel competitive pressure." That is game theory. If your economic competitors hold Bitcoin and it appreciates, you fall behind. So you have to hold it too, just to stay neutral. That creates a Nash equilibrium, where not holding Bitcoin becomes the riskier position than holding it. And institutions know this. If sovereign nations are buying, corporations must consider it. If corporations are buying, asset managers must offer exposure. If asset managers offer it, pension funds must evaluate it. The cascade effect is real, and it creates unstoppable momentum. First movers get best prices. Late movers pay premium. Institutions understand this, so they are moving now. Reason 8. The data shows institutional buying is accelerating. Let me show you the numbers. Over 160 institutional holders now maintain Bitcoin treasuries. Combined value, $150 billion. Coinbase and EY Parthenon surveyed 352 institutional investors. 83% plan to increase crypto allocations in 2026. 59% targeting positions exceeding 5% of total assets under management. That is not testing, that is conviction. And more than half of traditional hedge funds now have digital asset exposure, the highest ever. This is not niche anymore, it is mainstream. Record $40 billion in ETF trading volume happened in a single week in November 2024. BlackRock's IBIT accounted for 70%. That is institutional flow, not retail. Big money, patient capital, long-term holders, and they are not selling. JP Morgan's 2026 outlook says crypto will keep posting wins despite market volatility. Why? Because regulatory clarity improved, infrastructure matured, use cases proved. The foundation is solid. Galaxy Digital predicts Bitcoin hits 250,000 by end of 2027, based on institutional adoption velocity, not retail FOMO, institutional flow. That is the new driver, and it compounds. What this means for prices? The supply shock coming. Here's the math. Bitcoin has 19 million coins in circulation, 2 million lost forever, so 17 million available. But exchanges only hold around 3 million in liquid supply. The rest? Long-term holders, lost keys, institutions. When Strategy alone holds 761,000 coins and BlackRock holds 782,000 through IBIT, that is 1.5 million coins locked by two entities. That's 9% of available supply, off-market, not selling. If institutions keep buying at current pace, liquid supply shrinks, and when demand meets constrained supply, price goes vertical. This is not speculation. This is supply and demand, basic economics. Every institution that buys Bitcoin removes supply permanently. They're not traders, they are accumulators. 20, 30, 50-year holds. That creates a supply shock, and supply shocks create price explosions. We saw it in 2020 to 2021. We will see it again. And this applies to ISO 20022 coins too. XRP at $144, XLM at 16 cents, HBAR at 9 cents. When institutions start buying these for settlement infrastructure, the same dynamic applies. Limited liquid supply, institutional demand, price appreciation. Not overnight, but inevitable. Because the use case is real, the infrastructure is being built, and institutions are positioning. If this breakdown of why financial institutions are buying crypto finally made the institutional thesis clear, smash that like button. This is not retail hype. This is BlackRock, JP Morgan, Fidelity, the smartest money on earth moving into crypto, not out. Subscribe for content that follows institutional money instead of social media narratives. Drop a comment. Did you know institutions hold $150 billion in crypto, or that 83% plan to increase allocations? Share what surprised you most. And share this with someone who thinks crypto is just retail speculation, because when the world's largest asset managers are deploying billions, that narrative is dead. This is institutional infrastructure now, and you need to understand why. I will see you in the next one.